So rates are going to get incredibly higher, which is going to crush world economies. It's already doing that right now, which means that when you're raising rates and everybody else is in a much shittier position than us, it means they're going to continue to pour into the dollar from here. Okay, and that's one major problem, one massive headwind for earnings. Because if you look at earnings, how much does the dollar hurt? It hurts a lot. And you're looking at 29% of the profits from the S&P 500 companies come from overseas. If you look up Google, that's what it's going to say. Again, for guys like me, we break down the data. So you're like, oh, all right, well, we'll just, not worry about those companies within the S&P 500 that have a lot of exposure. But let's break it down a little bit. Because if you're looking at technology companies, tech companies they rake in 60% of their revenue from overseas. Well, tech is still by far the largest weight in the major indices. Apple, Microsoft, Google, the FANGs, throw in NVIDIA, AMD. And tech accounts for 30% weighting in the S&P 500, right? So to put that in perspective, this is higher weighting than healthcare and consumer discretionary combined. So they're the ones that are getting hit the most, and those are the ones that are going to see earnings come down, which is a pretty big deal because you're going to see the dollar go higher. And you might say, well, it's not really that much. It's not going to be that crazy. It is going to be that crazy. And if you think I'm crazy, just look at some of the companies, the technology companies, and even some of the healthcare companies. You look at IBM, they said the climbing dollar last quarter could slash revenue by $3.5 billion. Netflix said the dollar's performance had erased $339 million in profits. It's stronger now from when they warned, by the way. Johnson & Johnson, the stronger dollar could eat away $4 billion in sales. All right, so if you think the dollar's not a big deal, think again, because that's one of the headwinds that really not too many people are factoring in when I look at the analyst estimates, right? Because analysts are coming down, the issue of a slow economy, but it's also the dollar. And these companies don't say anything when, the dollar's weaker and their profits are high, but now you're going to see X currency. That's what they're going to say. X currency, this is how much we earn. That's one of the things. The other thing, too, and by the way, financials and industrials account for another 20% of the index, and those are the other two sectors that have a lot of exposure overseas. So the largest sectors that count for the largest weighting in S&P 500 have the most exposure to the rising dollar and most exposure to profits overseas, which means those earnings are going to get hit the hardest. And when they do, that's going to result in the S&P 500 falling a lot more than you just saying, well, it counts for 30% of S&P 500 profits, because the companies, when you look at the weightings, it's a lot bigger than that. So now they have decent balance sheets. They raise money, whether through bonds or whatever. And a lot of those bonds are going to pay later on. They have cash on the balance sheets. They were supposed to use this for buybacks. Amazingly, we're not seeing buybacks. Buybacks are supposed to be crazy strong. These stocks are down 30%, 20%, 50%. Some of them, if you look at Netflix and Meta, they're not buying. Why aren't they buying back stock last quarter? Why? Because they're looking at the current environment going, holy shit, we're in a lot of trouble here. Earnings are going to crash, and we need to make sure our balance sheets are strong. This way, we'll come out the other side one of the strongest players. So, those are two catalysts right there that you were supposed to use to buy stocks. Now, for those of you who don't understand the earnings picture and the PE ratios, which is fine, this is our job to explain it to you. It's price to earnings. So when you see a stock come down 20%, it doesn't necessarily mean that it's cheaper. It actually could be more expensive. And a stock rises by 100% year over year, and it can actually be cheaper than when it rose 100% because earnings absolutely surged. It's all about the earnings number. And let's talk about that because, and it started to go on here, but this is important, guys. So you look at the S&P 500, the PE ratio, right? Not forward, but trailing. It's been over 18 every year since 2016. And you have the bears saying, well, since 2016, to 2021, right? Not even this year, 2021. It's been over 18. And we've had a lot of bears saying, you got to sell the market. It's terrible. The average is usually 15. And most of those years, it's been over 20. But we've never had zero interest rates, right? Which promotes more money coming into stocks. And if you look at the earnings growth from 2016, what do we have? We had 10% 16, 16% in 2017, 20% in 2018. 2019 was 6%. 2020, COVID was down 30%, but then immediately we rebounded 110% earnings growth in 2021, and then 54% earnings growth in 2021, right? So we saw 100%, 10% earnings growth, and that was towards the end of 2021. So if you take those numbers, right, I'm throwing a lot of numbers at you, I'm going to condense them. Here's what you need to know. The annual earning per share growth is 25%. When you account, even you look at the 30% loss in 2020, since 2016, and you're looking at that for the past 7 years. And when you see the 25% annual earnings growth, the average PE ratio was 24 times. So at 24 times, you're not really that expensive because you're growing earnings at that 25% annual rate, which includes that big number, right? But still, even if you're growing earnings at 20%, which is more in line, you're looking at it close to that earnings per share number, where the 25 times earnings, the average multiple, and you're looking at 25% annual earnings growth. So you're not really expensive. Right now, again, earnings growing 25%. Earnings declined last year, ex energy, 4%. They're probably going to be down next year as well with all these revisions, fewer buybacks, the rising dollar. I mean, you're seeing this. Maybe they're able to cut back enough where their earnings are going to be okay, but you're going to see sales come down incredibly. Based on earnings declining this year and next year, our PE should be in the single digits. Because, again, those earnings per share, these estimates assume that the dollar would fall, but it wouldn't be, again, the dollar will fall a little bit off this, but it's still going higher and higher. And the fact that the Fed's raising rates means it's probably going to still go higher because that's going to hurt every other country. And they're going to continue to flock into dollar safety. So the dollar's probably going to continue to go higher. So when you're seeing stocks come down 20% from here, you're thinking like, wow, they are cheap. They are much, much more expensive now with earnings not growing. And that's what you have to realize, because the current conditions of the market, what Powell is saying is he wants unemployment to go higher. He's going to aggressively raise rates from here while housing's basically shut down. Semis are warning, industrials are warning, retails are warning for lower profits. Auto companies are starting to warn. These higher rates are going to crush the world economies, meaning the dollar's going to go higher, moving much, much higher from here. I mean, under these conditions, how do you see stocks going higher over the next 6 to 12 months?
Very difficult.
I'm not saying you can't buy some of the dividend players and things like that, but you're creating a scenario that's promoting tons of money to come out of this market. And we're not even close. We're not even close. I wish I could listen. I run a service where people pay me to give them stock ideas and stuff. And I'm telling you that right now, if you're looking to buy equities, again, doing this for 30 years, what are the catalysts here? When you have the Fed, the catalyst, remember, the last 10 years pre-COVID, people were saying, well, you're going to buy stocks, you're going to sell off, they're going to sell off, they're going to sell off. The catalyst was you had the Fed at zero interest rates, buying bonds, fund the money with system, and don't be an idiot and put your money into anything else other than equity markets, investments, housing, assets, and things like that. Forget about cash. Now it's totally the opposite. So by saying that you want unemployment to go higher, you're raising rates, and you're going to make the U.S. dollar automatically go higher, those conditions, if you look back at history, zero. The market doesn't go up. Stocks don't go up under those conditions. And that's what scares me.
Well, it is frightening. Powell is pulling forward Halloween, Frank. He's trying to do his best boogeyman thing, and it's working. I get your point. I like the breakdown of the sectors and things. Turning back to energy real quick, the wild thing there is that the energy sector, I believe I was reading earlier this week from the Wall Street Journal, still trades at like 8 times earnings. It's still very cheap. Why is that cheap? Well, it's because people are projected out in the future. We're transitioning away from oil. Oil demand will decrease over time. Therefore, it's okay for the sector to trade cheap right now. I totally disagree with that. That's one of the shopping list and areas you should be in, paying attention to, following, or at least scaling into for a lot of numerous different reasons. But I would say to stick to what's working. Look at energy, look at different things, chemicals. If we go through this long, drawn-out period, you and I were talking the other day about an interview with Palantir and Stanley Druckenmiller, not the other way I butchered that hedge fund's name. But he was talking about, hey, what if we go through a long, pertained period of sideways? I think from 1966 to 82, the Dow Industrial Average was basically between 600 and 1,000 points, basically flat. The S&P went up on average, I think, 6.5%, but inflation was that. So you're looking at a terrible situation. Even if that's the case, we'll still find ideas. I mean, people, and I know you're not telling people to panic, but you're being honest. Right now, again, from our position in the business and everything, the right thing to do is to tell people what's going on and why you should be nervous. However, you should always keep stacking cash, keep to your plan of savings and all that, because there will be a better time to enter into everything. But there's a great article we'll talk about next week or something, Frank, but Oxy Petroleum with Buffett. There's a great article in the Wall Street Journal from a week or so ago about what the CEO went through with battling with Carl Icahn, hedge fund, big stake, to Buffett and all that kind of stuff. My point is that, and I know you're not saying everything's going down. In the short term, it may, because it's going to be hard to fight the Fed. But that doesn't mean that you shouldn't keep having cash on the sidelines for the next opportunity, because it will happen. Unfortunately, it just looks like it's going to be more weighted towards the end of half year or early into 2023 at earliest.
And that's the thing that I think that's going back and forth with people, what I'm listening to. I like to listen to CNBC and I'll watch Fox Business and just gauge sentiment from, what a lot of these people are saying. I mean, if the dollar is going to go higher, right? It's going to go higher. You're raising rates, and if you look at the debt situation across the world, it's horrible, and people are going to flock to the dollar even more. So it's going to continue to go higher. What does that mean? Good luck for gold. Good luck for gold. And I could say good luck for oil, because oil almost never goes up during a recession. Almost never. I mean, when I'm looking at this, and here's the deal, where you're looking long-term, stocks always go higher. They do. They always go higher. But there's certain periods where it's crazy. Now, I'm not saying that stock's going to go down for a year and a half, but I am saying that we are going to see a steep decline from here. And I'm hoping it's quicker rather than later. And if we could see a 30% decline in stocks next month in October, and the Fed starts lowering rates by February, March, or we could see this being a long, drawn-out recession that's, basically already started, and stocks just grinding 20, 30% lower from here over the next 6 to 9 months. Either way, it's hard to see a scenario where stocks aren't going to fall. And when they fall, it's going to be because of profits. And you're going to see profits drying up. And the Fed's going to be like, okay, wait, let's stop looking at the CPI. And we have to be careful here. And that's when you'll see the opportunity to come in and really invest. But it's just a time frame. Mm-hmm. There's no way we're going to keep interest rates well over 4%. But it's not over 4%. Looking at over 4.25% for the entire year next year. Think about that. We're at 3. Look at what's happened in the last 6 months.